A couple came to me because they wanted to make their portfolio more sustainable, which I love doing. What they didn't realize was how much money I was going to save them on investment management fees. Mutual funds have very high management expense ratios, MERs. And by switching to pooled funds or exchange traded funds, ETFs, I was able to save this couple more than $1.3 million over the course of their investment horizon. Let's jump in. Sometimes people get a little funny with me when I tell them that I charge $1,000 per hour as a financial planner. They wonder, what could I be doing that is worth so much? Like, how is it worth it? Well, I'm here to tell you that the work of a certified financial planner can be hugely valuable to you. And specifically, the way I save people money is by lowering the fees on their investment products. Most people have no idea what kind of annual fees they're paying. And so by working with me, we're able to lower people's management fees in a way that saves them 4 figures, 5 figures, 6 figures, even 7 figures over the course of their investment horizon. It's kind of ridiculous. Most people come to me because they care about sustainability and they're looking for ethical investments or good investments. But what's really interesting is that when they work with me, I end up saving them boatloads of money. And here's how. In my last episode, I talked a little bit about this very special acronym called MER, Management Expense Ratio. This is one of the common questions I get as people learn about this. They hear about it somewhere and they're like, Tim, what the heck is an MER? Well, a management expense ratio is code word for the annual fee that you're paying for the investment management and everything that goes into it. So it's a percentage basis, right? It's usually like, for mutual funds, it's going to be about 2%. But that's going to be every year. You're paying 2%, however much you've got invested, you're paying 2% of that in fees. Now, the problem is that with ethical funds, these mutual funds are even more expensive. So I'm going to use a case study. This is a couple that I worked with a couple months ago. They came to me. They had done pretty well. They had managed to save up about $150,000, which is awesome. They're 30 years old, right? Part of that was an early inheritance, but most of it had been their savings on their own. They had just walked into a credit union and asked for RSPs and TFSAs and, hey, what do I do with my investments? They got sold mutual funds, specifically from this company called NEI, Northwest Ethical Investments. Now, if you're kind of an old school person, if you went into your credit union decades ago, you would have been sold ethical funds. That's what they were called back then. These were some of the first ethical funds in Canada. They've gone through some mergers and acquisitions such that now the company is NEI, Northwest Ethical Investments, and they were sold these ethical funds. Now, I have a lot to say about how ethical they actually are. I have some feelings about that. To give you an example, ExxonMobil is one of the holdings in there. So I think there's certainly more that we could do from an ethical lens. But today I want to focus more on the financial side of things and really help you understand why these are actually a giant ripoff. So the product that they got sold was this NEI Select RS portfolio. NEI Northwest Ethical Investments, RS is their responsible solution, I believe is the acronym. This is a responsible investment portfolio solution offering consistent income with potential for long-term growth. This word balanced means something very specific, which is that it's 60% stocks and 40% bonds. That's quote unquote balanced portfolio. That's the term that we use. The issue that I have with this, we can talk about the ethics and what's inside and what they do. I'm fine maybe doing a separate episode about that. If you want that, let me know in the comments. But today I'm just going to focus on fees because this has this MER, this management expense ratio of 2.36%. This is even higher than a normal mutual fund. When you walk into the credit union and you ask for an ethical investment, this is probably what they're going to sell you. But in my mind, this is kind of like slapping that organic sticker on an avocado that they used to do back in the day, where, okay, we can talk about how much more sustainable it is. Yes, they are doing some things, but they are charging you such a premium. And the impact of this is just massive. And so, this couple had come to me, like I said, $150K invested. They're saving about $1,500 per month. So it's about $18K a year is going into this portfolio. They're 30 years old now. We figure let's run the model until they're 65. So, we'll run it for 35 years and kind of see how far that gets us. So what I did is I used this tool that I built. So this is a little Excel spreadsheet. This is my forecast tool. I've got this as a free resource inside of the Good Investing Classroom. These are the types of tools and resources I've got inside the classroom. Would love for you to join it. I will make it available here on YouTube and in the podcast notes so that we can put the link below if you do want to play with this. If you haven't signed up for my newsletter, make sure that you have. There's a link there. And then what I want you to do is make a copy of this. Please don't edit this. You can make a copy and make your own version of the tool. So here's the model that I've run. Basically, all of these highlighted cells are assumptions that I've made. And if you're listening to this on the podcast, apologies. I'm going to do my best to verbalize everything that someone who's watching it has seen, but we will make the video available to you as well. So I'm going to assume that inflation at 2%, very standard. This is sort of the Bank of Canada's long-term expected inflation. I'm assuming an annual market return of 6.5%, which is fairly conservative. Over the last several years, it's certainly been more than this. A balanced portfolio has done a lot better than this, but we want to be conservative with our assumptions. If I was going by the Financial Planning Canada guidelines, this would be even lower. This would be about 5.5% per year. I feel that that is very, very conservative. So I'm going to go with 6.5%, which I think is still pretty much on the safe side. From there, we're starting with 150K and an annual contribution of $18,000. So every year they're adding 18K to their portfolio. Now, the first model that I ran with them is that for people who, really just want to have that full service advisory solution where, if you're walking into a credit union and you're asking to speak to an advisor, presumably you want someone to do this for you. So the first scenario I'm going to run is that instead of mutual funds, if we did something called pooled funds. So pooled funds is where we pool our money together with other investors. A lot of folks who've been following the channel know that I've got a partnership with a firm called Genesis Capital. Genesis offers pooled funds where you're pooling your money with the David Suzuki Foundation and with Greenpeace Canada and with a whole bunch of other environmental and social justice organizations, right? And so we can get the fees down there that even at the lowest level, right? If you're starting with less than 250K, this is like the most expensive it'll ever be, is 1.7% annually. Now, these are going to be all of their fees, including, custodian fees, everything like that. There is a small little Tim Nash discount that if you go through my link, you do get a little 0.1% discount, Tim Nash discount. So that's why it's 1.7 instead of 1.8. And again, as you have more money, these fees will come down for pooled funds. That's just how it works. That the most expensive it'll be is 1.7, but as you get above 250K, it'll come down. As you get above $500,000, it comes down more. As you get above $1 million, it comes down even more. And then if you can get above $5 million, congratulations, you get the lowest fees that you could sort of possibly get at that point. But I'm assuming that, they're just coming in with 150K, so they're going to be paying those highest fees. And my system doesn't really have a way of as their portfolio gets bigger, the fees go down. So I'm just assuming a 1.7% for the entire duration of 35 years. So if anything, again, my assumptions here are a little bit conservative in terms of how much you're going to save. So the way it works is I'm going to come over here and I'm going to start to look at the years, and we're going to look at it year by year. So after 1 year, the growth of a 150K portfolio with the old fee, right, with the mutual fund, is that you would end up with $156,210. But with the lower fee, if you went with the pooled funds instead of the more expensive mutual funds, you'd end up with $157,200, saving you $990, almost $1,000 in year one. But the interesting thing is that this compounds. This is $1,000 that you're saving that's staying invested in the markets. So that every year this number is going to get bigger and bigger, such that after a decade, after 10 years, with the mutual funds, under that scenario, this couple is going to have $424,000, not too shabby, but we can do better. By having lower fees with these pooled funds, they'd have $446,000, having saved them $21,000 over the first decade, over 10 years. But again, that money stays invested. And the way compound returns work is it gets bigger and bigger. After 20 years, instead of $863,000, the couple will have $947,000, saving them $84,000 in fees. After 30 years, under the expensive mutual funds, they're going to have about 1.5 million, whereas with the cheaper pooled funds, they're going to have 1.75 million, saving them $227,000. And then after 35 years, which this only gets them until retirement. Again, over their lifetime, these numbers are going to get even bigger, but let's just run it until they're 65 in retirement. You know, with old mutual funds, they'd have just a hair under 2 million. With the lower fee pooled funds, they're going to have over $2.3 million, saving them $350,000. So it's a first step. Even if you don't want to learn how to do it yourself, just want someone to do it for you, by switching from expensive ethical funds into pooled funds at Janus, they're going to save $350K. Not only that, the portfolio is more sustainable, no ExxonMobil, that's for sure. And they're going to have better service. That with pooled funds, you know, they're going to be checking in with you once a year, no matter what, like at a minimum. Whereas, you know, if you've gone into a branch and you get sold mutual funds, you never hear from those people. Some of them are better than others. I don't want to be like all advisors are terrible. Sometimes you get lucky and get a good one. But most people I've spoken to who just buy investments kind of from the branch of their bank or credit union really never hear from the salesperson after that. So, you know, really to me, this is an incredible way. This is a really easy way for them to save $350K, have a more sustainable portfolio, and be getting better service over their investment career. It's kind of a no-brainer. Like, this is probably the easiest $350K someone will ever save in their life, is just switching from mutual funds to pooled funds. Now, that's just the first step, because if they're willing to put some work into it, and if the couple is willing to go further and learn how to do it themselves, instead of pooled funds, they can invest in exchange traded funds, or ETFs. I've done some examples of some sustainable ETFs. One that we looked at was GBAL, GBAL. This is the iShares Balanced ETF portfolio. This has an MER of 0.25%. Now, it's still a balanced portfolio. It's still a mix of 60% stocks, 40% bonds. The sustainability is definitely comparable, probably, you know, a little bit better on the divestment side in that it's not going to have ExxonMobil. It's not quite as good on the shareholder engagement side. That one thing that NEI does really well is pushing companies sort of in that direction. That's something that pooled funds do as well, but it's something exchange traded funds don't really do. So that is, we are giving up that shareholder engagement, but we're reducing our fees by about 90%. And when we look at how much money they're going to save, the numbers get absolutely wild. In the first year, instead of 156K, you've got 159K, saving over $3,000 in the first year. All of a sudden, my hourly rate of $1,000 doesn't seem so wild. That if, you know, someone hires me for a couple hours and gets them set up with this, and this is for a 150K portfolio. If you had a bigger portfolio, these numbers would be bigger. After a decade, it's wild. Instead of 424K, they've got a hair under $500,000, saving $72,000 in the first decade. After 20 years, instead of $863,000, they've got over $1.1 million, saving over $300K over 20 years. Over 30 years, instead of $1.5 million, we've got almost $2.4 million, saving this couple $871,000 over a 30-year horizon. And when they decide to retire at age 65, right? This isn't the end of their investment career. They're going to save more than this. This is just how much they have when they're ready to retire. Instead of, you know, a hair under 2 million, which, hey, if you had a hair under 2 million, you know, through mutual funds, great, not too shabby, but my goodness, we can do better. With ETFs, they would have over $3.3 million in their nest egg, saving them almost $1.4 million. $1,383,767.58 by my math. It is absolutely wild how much money people save by lowering their management fees. But it's also absolutely wild how much of a ripoff those mutual funds are that just get sold out of the bank branch. So do me a favor. Like, I want you to invest sustainably. I absolutely do. I don't want you to get fleeced. So I want you to take the time to give some thought to this, that if you've been thinking about switching to sustainable investments, right? Know that we can do it in a way that lowers your fees dramatically. So not only do you get a more sustainable portfolio, You also lower your fees, which is one of the biggest things you can do for you and your family, and keeping this money inside of your pocket. If you're ready to take control of your investments and lower your management fees, I'm here to help you. You can set up a free consultation with me at goodinvesting.com. You can set up a free consultation with Daryl if you're interested in exploring Genesis full service options. And you can join my classroom to get access to all kinds of amazing resources, including how to start sustainable investing in 15 minutes, where I show you how to buy ETFs as quickly as possible. If you've made it this far, please subscribe and like the video. Leave me a comment. Let me know what your MER is of your portfolio. I'd love to hear from you, and it's the best way to help more people watch this video. We'll see you next time.